Welcome to Opto Sessions, where we interview the brightest minds from the stock market, uncovering their secrets to success. If you're looking for ideas, tips and techniques from the world's best, you're in the right place. Hello and welcome to Opto Sessions. Today we're lucky to have Ivan, or Ivo for short, a portfolio manager at Zor Capital, who has successfully been trading equities and options for over 18 years. He's also the author of numerous books on trading, such as Crash, How to Protect and Grow Capital During Corrections, and his latest release, Swing Trading with Options, How to Trade Big Trends for Big Profits. We'll be digging into these themes in a bit more detail in just a second, but without further ado, welcome, Ivo.
Ed, thank you for having me.
Great to have you on the show. And I just wanted to start by going into how did you get into investing, basically a bit of background about yourself.
So I was born and raised in Bulgaria. And while at university, I was reading a computer magazine on a monthly basis. And that computer magazine had a small section for about 2 pages dedicated to the stock market. And these were my initial steps. This is when I started to read a little bit about the market, and it sparked my interest. And I invested a small amount in the Bulgarian market at the time. And in the mid-2000s, the local market was going up basically on a monthly basis. So I saw a significant return, and that basically what sparked my interest and my passion. And later, a couple of years later, I moved to the US to study finance. And this is where I further dived into trading and investing. And some of my first steps here in the US were basically just reading financial blogs at the time. They were starting to get very popular. Like Howard Lindson's blog was one of them. This is how we actually met with him, through his blog. Started reading Investor's Business Daily, and then various books on the topic. And this is how I really started. I mean, no one in my family had ever owned a stock. So basically I had to learn from other people in books and newspapers.
And would you consider yourself both a trader and investor? Do you utilize sort of both strategies there? And could you, just for the audience, clarify the distinction in your eyes as well?
I mean, everyone has a different definition, right? I mean, I think I'm primarily a trader, but there are different types of trading. There is intraday trading, where you close all your positions at the same day. There is swing trading, which lasts 1 to 10 trading days. There's position trading, which could last multiple weeks, even multiple months. And I do all of those three. And then investing is, I mean, in my eyes, is just buying something the way Warren Buffett does, really for the long term, buying a strong stock of a strong company and just staying in it for multiple years, or just buying an index like here in the US is the S&P 500 or the Nasdaq 100,
yep.
And just dollar cost averaging in that every month and just hold it for 30 years. Investing in my eyes. And I do have a small retirement account that does a little bit of that, but I'm mostly a trader. This is how I make my money, by just speculating in the stock market. So,
and what is it about stocks in particular that keeps you sort of trading them, as opposed to Forex and other stuff, indices even?
I mean, I've never even tried Forex, and I just started in stocks, and the market is liquid enough here in the US, and this is where I develop an expertise and an edge, and this is why I stayed with it. I mean, from my understanding, Forex involves a lot of leverage, which is the worst thing that you can give to a novice, and I think most people, especially if they don't have enough experience, should start with no leverage. And as you build more skills, you can add more tools to your trading arsenal. But as you said, I don't really know much about Forex, so I've always traded stocks and options. And that's plenty. The market is big enough, so I don't
Yeah.
to diversify any further than that. What about you? Do you trade Forex?
No. I was just interested in obviously that was how you got into the market, but sometimes some people don't know the but they want to find a reason to trade one asset over another, and it's just interesting sometimes to understand how other people's thought process went into it. But a lot of the time it is just what you've developed a preference for and an edge in. Why would you change anything else if you found the way of doing it right in one asset? So, and in terms of market crashes, I wanted to go into a bit more depth about that, especially because of the sort of market at the moment, which is obviously crashed and then recovered quite strongly at the moment. It seems an opportune time to kick off the podcast discussing that. In your book on market crashes, you mentioned that patterns repeat all the time because the human mindset hasn't changed for thousands of years. I was just hoping you could take us through a bit of the psychology behind typical stock market corrections, and in particular how people's perception changes as they pass through different stages of a correction.
Yeah, I mean, the different types of correction. I mean, I typically divide them into just two types. One is just shallow, normal pullback within a bull market, which typically it can last several weeks, and it's about 4 to 7-8%. And they're normal. They happen at least twice a year, every year. And then there is a bigger correction that could last multiple months, and that where the major averages go down 20, 30, 40, sometimes more in percentage points. So typically, most corrections start with some momentum divergence. For example, a major index like the S&P 500 can continue to go up, make new highs, with fewer and fewer stocks participating, meaning that we're seeing a divergence between the index going up and then the number of stocks that are staying below above their 50-day moving average, for example, is decreasing. That's one form of divergence. And of course, it's not an exact science to call a top. That's it's really hard. But typically, when we see a decreasing participation and a lot of distribution in the indices, and distribution basically means sign of institutions selling. When you have an index like the S&P 500 down more than 1 or 2% on a daily volume that is above the previous daily volume, that's one distribution day. So when you start to see a big cluster of those distribution days in a short period of time, let's say 5, 6, 7 within 2-3 weeks, that's typically a sign that big institutions are selling their shares for whatever reason. So these are the two things: the institutional selling and also momentum divergences that typically start corrections. We know at the beginning of every correction, we never know if that correction will be a shallow one or a deep one. The only thing they have in common is that when market starts to fall, usually there is a spike in volatility. So one of the most common sense to hedge at this time, or just to speculate, is just to get long volatility. You can just buy here VXX calls, which I did earlier this year in February, while the S&P was near its all-time highs, or you can just buy a put option on an index or some of your holdings just to protect yourself. So in my experience, and by also studying previous corrections, I noticed that the deep corrections typically have several distinct stages. And in the stage one, we typically see a big, quick drop lower, which marks the momentum low. We can see an index go down 10, 15, 20% in a week or two, a very quick sell-off. That scares everyone. And then typically after this first leg lower, there is a quick retracement, a quick bounce, snapback, which retraces about 50% of the first leg lower. And after that, after some time of choppiness, eventually we see a test of the momentum low from stage one, the so-called momentum low. And during that test, we see another momentum divergence, but this time it's a positive momentum divergence. When the indices test their momentum low, sometimes they go below it, and in the same time, the number of stocks that are making new 50-day low is just decreasing, or 52-week low. They do not confirm what the indices are showing, and this is just one of the signs that that we might have a short-term bottom. And if you study the past corrections, many of them go through the same stages. Typically, corrections, the deep corrections, they last long enough to condition most people to become very nimble and to sell positions very quickly, because if you don't, you see whatever profits you had evaporate. So those markets are very volatile. They're very crazy, and they're great for quick, nimble intraday traders, but they could be very challenging for everyone else. And this is why even investors become short-term traders during corrections, because that's the only way to kind of make money during that time. And of course, when you get conditioned to take profits quickly, later when the market recovery comes, that becomes a big issue for you, because all of a sudden you continue to take your profits very quickly because you've been conditioned to sell very early, while this time the breakouts follow through, and we typically see bigger moves in stocks, so you're missing out on much bigger moves. So it takes some time until you condition yourself again to stay longer with trends and not to sell too quickly. So, I mean, every investor goes through various, basically the same psychological stages during corrections. I mean, there is you go from fear of losing and wanting to get out at any price during the quick fall down, and then you can quickly switch to fear of missing out during a quick recovery.
And is there anything different you're seeing in the way the market's behaving in this sort of, would you call this a correction we've been through?
Well, the main thing that I'm seeing is that it seems this time everything is happening much faster. So in a matter of 6 weeks, we saw the size of correction that typically takes a year or so, historically to happen. And then the recovery was just as quick, typically a recovery that takes many months to happen. Here it happened in 4 to 6 weeks. So it seems like everything is happening much faster this time around. For whatever reason, I don't know if that's a sign that markets have become a lot more efficient or the opposite. But the magnitude of the moves have been incredible, and something that you see very rarely, because some of the ETFs that typically move 10, 12% a year. They experienced a 50, 60% drop in less than a month, and then a similar type of recovery. So it's almost like a flash crash, but slow down a little bit. So it's just definitely that this correction was a little bit different in terms of velocity. Yeah.
And what phase do you think we're in now? I mean, the Nasdaq's come. I think it's above the highs. Well, it's positive for the year now.
Yeah, absolutely.
After coming down, are we? Is this? Are these highs justified, or is there something strange going on? Or?
I don't think you can really make money in the market if you try to justify the moves with any logic. Just because the financial markets typically live in their own world, right? They constantly strive to predict the future, to forecast and discount something that hasn't happened yet. So for the past 6 weeks, the markets have been pricing in normalization of the economy and of our life. That doesn't necessarily mean that the market will end up being correct, but this is what the market has been discounting, and this is why prices have been moving up. So the market looks 6 to 12 months ahead in the future and is saying maybe things will go back to normal, but that doesn't mean that they will. So, but the market is not naive, right? So after the initial excitement and discounting phase of that recovery, at some point the market will start looking at the actual raw data, and we want to see a confirmation of that thesis. So if all of a sudden the company's earnings reports and economics numbers and the number of new coronavirus cases do not confirm the current market thesis, we might see, another correction, basically another leg lower. If the market all of a sudden realizes that, hey, my thesis is not correct. But as of right now, what the market is doing is basically looking into the future and betting that things might get back to normal at some point. And this is why the stock market can sometimes be a little bit counterintuitive to many, especially people who don't have enough experience in the markets, because you read the news headlines and the news is basically horrific. And then you look at what's going on in the stock market, and stocks just keep going up. And then you're wondering what's going on. And if you try to justify that in some way, and especially trade on that, you can lose a lot of money. And if you're a trader, all you can do is just follow price and manage risk, and just don't ask too many questions about the validity of this move or not. We're in this market to make money, not to philosophize if it's justified or not. At least that's my philosophy.
Yeah. No, it sounds like a very good way to approach it. And how can people prepare for market crashes whilst also trying to sort of maximize the gains in their portfolio during periods of growth?
Go ahead. Sorry.
Yeah, so you're trying to maximize your gains in periods of growth, but also want to be prepared for the downside of market crashes that might occur. It'd be interesting to know how you sort of position yourself to to still be okay during those periods.
Well, remember, I'm a trader, so for me, a spike in volatility, which usually comes with market corrections, means even more opportunities than during normal times or rising markets. For most people, most people, they're just having a regular 9-to-5 job that is not related to investing and trading. I don't think they can do much about really protecting their long-term investments. I mean, all most people can do is just dollar cost averaging in the indices on a monthly basis, and it's not an accident that a very popular manager like Peter Lynch says that far more money has been lost while trying to prepare for a correction than during the correction themselves. This is exactly for people who are not really active in the stock market. Like if after a 10, 15%, 20% pullback, all of a sudden you start thinking about how to protect your portfolio, in most cases you're maybe too late for that. So you're either an investor or either a trader. If you're an investor, just keep doing what you're doing. I think just dollar cost averaging in the indices, you can just have a few individual investments in a few individual stocks just to spice up your returns. But if you're a trader, I mean, it doesn't really matter if you have a growing market or a falling market. You can make money on both sides. And obviously, to capitalize on a correction, you need to be a trader. So you can play the short side as well.
Mm. And so, as a trader, how do you approach growing your capital during periods such as this, like market crashes? Where do the opportunities lie? How do you find them?
So, typically during bull markets, I'm mostly a swing and position trader. So I'm taking trades that usually last a few days, sometimes multiple weeks or months. So during market corrections, my trading time frames become shorter. So I do mostly intraday trades because during quick corrections, we typically see significant market gaps every single morning. Like we're talking 4 or 5% gaps. So which make holding positions overnight for a trader really, really difficult. So during corrections, typically in a single day, you can see moves that typically take years. So moves that typically take years, all of a sudden during corrections, you see them every single day. Every single day you see big stocks moving 10, 15, 20% on that for the day. And when you're a nimble intraday trader, you can just, you can take advantage of that. I mean, instead of waiting a whole year to make 20% in certain stock, you can do that every day during correction. This is why corrective market are actually the favorite trading environment for experienced traders, because this is when you can make the most money, because the higher the volatility, the bigger the opportunities. And
yep.
This is how you basically grow your capital during correction. Not only you can still grow your capital during correction, but actually corrections offer bigger opportunities than any other market environment if you're a nimble trader. And everything depends on your skills and on your market approach. I mean, obviously, if you don't have the skills or the capital to trade intraday, then you should not be doing it right during corrections. You should just go to cash if you're just a swing trader or position trader and just wait it out. This is what many people do who know that they're not good at intraday trading. They just, when they see the sign of an impending correction, they just go to cash, sell everything, and they just wait it out. And when they see the sign of a potential start of a market recovery, they slowly start to get back in and build their positions. Talking about traders, right? Not investors. We all investors. Yeah. So this is it's your choice. You can either be super active if you have the skills, or you can just go to cash and just protect it. And instead of going through a 20-30% even 40% drawdown, as the market averages do, you can limit your drawdown to 5-7%, wait it out, and then start trading again when you see signs of a market recovery. And yes, with this approach, you're going to miss the initial stage of the market recovery, but also you're going to minimize your drawdown.
Mm-hmm. How can people tell when the sort of market recovery has sort of begun and they're safer to start swing trading again, etc.? What sort of signals do you use to?
I mean, when you see breakouts, when you see more stocks on the 52-week high list, all of a sudden, especially growth stocks that are showing significant earnings and sales growth, when you see those stocks breaking out and holding their breakouts and following through, that's usually a sign that it's a safe time to get back in. Because during correction, you see a very low number of stocks on the 52-week high list, and typically those are super defensive stocks like consumer staples, like Campbell Soup, Kimberly-Clark, stuff like this, which not sexy names, not really high growth names, and the few breakouts that you see on the 52-week high list typically fail during corrections. If all of a sudden you start seeing more and more stocks showing up on that 52-week high list and more breakouts holding and following through, that's typically a good sign that strength will be spread into more sectors. So you can start looking for other proper setups and bases for you to buy and participate.
Yep.
So that's pretty simple. Basically, just watch the 52-week high list and how the market is reacting to those breakouts. And one more thing that I think is also helpful is to look at the market reaction to bad news. If all of a sudden stocks stop falling on bad news, as we've seen in this earnings season multiple times. I mean, last week we had companies like IBM, Intel, Target coming up with earnings numbers well below the expectations, and the initial market reaction was like a slight gap down of 4 or 5%, but those dips were quickly bought. So this is a typical example of how the market is ignoring the bad news, the current bad news, because the current earnings reports, they basically reflect the past, and the market is trying to look into the future. And so when you see that combination of positive market reaction to bad news and more stocks on the 52-week high list, breakouts that are holding and following through, these are pretty good signs that this recovery is sustainable, and then you can start putting some money to work if you're a position trader. And position trader, I would say, would need someone who would buy with the intention to hold multiple weeks or multiple months. Or even if you're a swing trader and you intend to hold just several days, you still need to see that sign to start putting more serious money to work.
Sure. And you say, so this would also be an indication of a bottom having definitely formed then, once you start to see all these stocks that are trying to push to new highs. It's just compounding on this idea that the recovery is stabilized and it's pushing forward.
I mean, the very first sign of a potential recovery is when you see positive momentum divergence, as I say, when you see the indices testing their previous lows or even going below it, while the number of individual stocks making new 52-week lows is decreasing, right? This is positive momentum divergence when the majority of stocks are not following what the major indices are doing.
Yep.
This is when some more nimble people can start to put a little bit of money to work, and this is where if you're a very shrewd long-term investor, you can get some amazing businesses at very favorable prices, 50-60% below their all-time highs. But there's so many different approaches to the market, and you just have to find the one that works the best for your own psychology and for your own skills and holding power, because every person has a different holding power, right? Some people are able to stomach big drawdowns, others are not. So
yeah. Well, so I think it's probably relevant time to move into discussing the Momentum 50, which is a popular list of stocks you maintain for your premium client list, which highlights stocks with momentum. Could you explain a bit about what this list is, and about momentum, so that people can understand, a bit about how these stocks are selected for the list?
Mm-hmm. Yeah, so that's an algorithm that I created a few years back in 2013, after studying what worked in the past on various time frames, on a monthly, quarterly, annual basis. I looked at the biggest winners, biggest stock market winners, and I looked what they had in common. And in many cases, what they had in common is established momentum. And there are two types of momentum. One is a so-called absolute momentum, when we're looking at the distance of the current stock price to its 52-week low. So typically stocks that have already doubled from their 52-week low are considered momentum stocks that are in an established uptrend. Then another way to measure momentum is based on the distance from the 52-week high list, from the 52-week high for the stock. So stocks that are trading within 10 to 15% within their 52-week high, even better, their all-time high. Typically, those are stocks in an uptrend that are potentially setting up. And in addition to that, for my list, I have some other criteria, like I look at how the market has reacted to the past, to the most recent earnings reports. If we see a favorable market reaction, a high volume breakout, that's typically very positive for the next quarter. I look at short interest. I look at industry momentum, because stocks tend to move in groups. And when you see, and typically industry moves are a lot more sustainable than individual stock moves. And I also take that into account. And at the end, I rank the stocks based on their technical setups. So stocks that show range contraction, stocks that which 20-day moving average is closer to their 50-day moving average. Typically, it's one sign of range contraction. Typically, they offer better entry points. So at the end of the day, the reason and the goal behind that list is to save you research time. So after all that screening, we come up with only 50 names, and those names can be excellent source for swing traders, for position traders, for trend followers, for intraday traders. So it basically saves you time, and it helps you to fish in a pond that is very likely to have some stocks that are likely to outperform. So instead of fishing in a big ocean of 8,000 stocks, at least that's how many stocks are here in the US, you get to focus on only a much smaller pond of 50 stocks. So you have much higher probability of capturing one or two big winners. If you're a position trader, or you have a much bigger chance of capturing multiple 5 to 10% moves within those momentum stocks. And yeah, that's it basically.
And When would you decide if a stock should be removed from the list if it's lost momentum?
Yeah, so the list is rebalanced on a weekly basis, and typically when we see a stock breaking below its 50-day moving average on high volume, typically it loses its spot on the list, and it just depends on its ranking. I mean, after I run all my scans and all my filters every single week, it can produce anywhere between 50 and 300 stocks, and they're just getting ranked based on their technical characteristics. And if they don't make the cut for the top 50, they're out. And typically they don't make the cut if they have a high volume breakdown below the 50-day, or there are some other stocks that are setting up and offering better setups. They're getting replaced.
Mm-hmm. And how do you decide so the stocks are chosen for this list, and how do you decide? Obviously, it'd be individual to different traders, but in terms of how you approach it, when are good times to open positions in this stock? Are you opening them immediately when you decide they have come into the list, or are you choosing ones that you feel have technically a better setups, or how do you go about that?
Yeah, I mean that's one way to do it, and everything also goes through the filter of what's going on on the general market. And if the major indices here in the US is the S&P 500, the Nasdaq 100, the Russell 2000, if all of them are above their 50-day moving averages, then typically that's a bullish market environment. And in this environment, you can just, buy the new stocks on the list. They're coming up every week, and just because my table of the Momentum 50 list shows how many weeks a stock has spent on the list, and some stocks stay there for a few weeks, some stay there for more than a year. And if they're marked with the letter N, which means new, that means it has just joined the list. And one way to approach it is just to buy the new stocks that have just appeared in the list, but only when the general market is in a confirmed uptrend. So that's a very simple way to approach it. If you want to basically trend follow or position trade those new ideas, and you can either sell on strength, when the stock gets super extended above its 50-day moving average, or you can just wait for the stock to be removed from the list.
And are you managing your trades out when you're in them, in terms of taking some profits off the table at certain points, or are you coming all out on spike highs like you're talking about? How do you approach managing your position when you're inside it?
So I like to sell on strength. So most of my trades are swing trades. They're short-term in nature, last between 1 and 10 days. So I do sell on strength. Once I enter, and that's after usually enter right when a stock is breaking out or breaking down from a base. And the typical move when stock break out or break down, the moves typically last between 3 and 5 trading days before they encounter some form of resistance or support if you're shorting. And I want to stay in those stocks only while they're moving. So I just sell on strength. I have my target levels. It's just depending on the setup, and I just sell in stages. If I buy a stock at 10 with a stop at 950, and I can sell a quarter when the stock gets to 1050. I can sell another quarter when it gets to 11, and the rest when it gets to 12, where my ultimate target, let's say, would be. Mm-hmm. I like to just partially sell on strength instead of just sell at just one just one specific target, because in many cases the stocks might not reach their targets, and just taking a little bit off the table just increases my holding power in a way. So because I've taken a little bit of profits, my risk has been reduced, so I can stay longer. I don't need to really move my stops. That I can just leave my original stop where it was. Because if I keep moving my stop very aggressively, there is a very high likelihood that I might get stopped out prematurely out of a good
Okay,
trend.
So you prefer to take money off the table rather than aggressively moving your stop?
I mean, yeah, those are the two main approaches, right, in trading. You either move your stop, just wait to get stopped out by the market, or you just aggressively manage your position and just take partial profits on strength at levels where it makes sense. For example, if I'm risking 50 cents per share, I'll probably sell a quarter when my stock shows that it made me 50 cents, because I risked 50 cents. If I sell a little bit of 50 cents, that basically means I've achieved so-called 1 R. So R is the risk to reward ratio. Typically, we traders, we look at those, and we strive to get into setups that offer higher rewards than the initial risk taken. Because in most cases, it doesn't matter how experienced you are, your success rate will vary, but on average, it will be like 50-60%. So to be profitable in the long term, you need to make sure that you enter setups where the potential reward is at least 1.5 to 2 times, if not higher, than the risk you're taking.
And how do you approach slippage as a risk, sort of when you enter trades? Obviously, when you hold them more than one trading day, you can lose. Your risk reward can be affected by that, obviously.
Yeah, absolutely. I mean, you will have cases where when you have a swing trade position or position trading position, when a stock can gap below your stop if you're long, or gap above your stop if you're short, and it's on a case-by-case basis. Typically you wait the first 10-15 minutes to see if there will be a move in the opposite direction, there will be a fade, and you just get out. You just take the loss and move on, because when you're an active trader, one trade is not going to really make or break your year. In a typical year, you're very likely to take hundreds, even thousands of short-term trades. So in the big scheme of things, 1 or 2 or 5 trades are not really that important. And this is why we say that position sizing is so important, because when you enter a trade, you know exactly how much you risk, and in most cases, let's say that you risk 1% of your capital, and this is how you define your stop and position sizing. Let's say you buy a $10 stock with a stop at 9. That means you risk $1 per share, and let's assume that your trading capital is 100,000, and you want to risk 1% of your capital per idea. 1% of 100,000 is 1,000. So 1,000 is your risk per trade. So going back to the example of buying a $10 stock with a $9 stop, where you risk $1 per share. So you get your total risk of $1,000 divided by your risk per share, which is 1. That means that you can afford to buy 1,000 shares. 1,000 shares times 10, that's $10,000 allocation, or 10% of your initial capital. And obviously, in some cases, sometimes the stock can gap below your initial stop, but those cases are rare. And they do happen, but they're rare.
Yep. And you've also mentioned previously that there are only a few strategies to achieve big gains over time. One of these was to hunt for several huge winners in a year, build large positions in them, and ride them basically. I was just interested to know how you go about finding those winners to build those positions in. What would highlight those individual stocks as good potentials on that front?
Yeah, I mean, the main thing you should be, if you want to position trade, that means hold a position for multiple weeks or months, you need to be looking at volume. So you need to be looking for stocks that are breaking out to new 52-week highs or new 50-day highs on huge volume compared to their average daily volume. Let's say you see a stock that is up 8, 10, 20. If it's a biotech, it could be up 50% on that day, and it's already trading something like 20 or 50 or 100 times its average daily volume. We're talking millions and millions of shares in a stock that typically trades, let's say, 100,000 shares a day. This is often a good sign that there is urgency among buyers, and there is a big story behind that move. And in many cases, those huge volume breakouts have continuation later. And I'll give you one example. Last year, I mean, there are a lot of examples every single year, but there's a biotech stock called Axsome Therapeutics, symbol AXSM. And at some point last year, it had a huge volume breakout. I mean, currently it's trading around $100. But just 1 second. All right. So at some point last year, in February of last year, the stock was trading around 30, 40,000, between 100 and 200,000 shares a day. And it was trading around $3. Then all of a sudden, in January of 2019, it has a huge gap. So it gaps from 3 to 7. So that's more than 100% gap in that stock. And that stock traded on that day 51 million shares. So it went from trading 200,000 shares to trading more than 50 million shares on that specific day, and it more than doubled on that day. So if you fast forward less than a couple years later, that stock is trading at 100. So from 7 to 100, you can just make the calculation. So just look for huge volume breakouts. Not all of them are going to work, and this is why we use stops. But the ones who work will more than pay off for the ones that don't. And I mean, this is the most simple way, I think, to find potential big winners, and especially when there is there's specific news behind that gap and behind that, usually earnings related, or if it's a biotech, if it receives FDA approval for one of its drugs. That's typically it is basically the most simple way to find big potential winners. And as always, there is nothing certain. You still need to manage risk, and you should not be putting all of your money into one stock, no matter how much you think the potential is. Just take 10 of them. Maybe 5 of them are not going to work. You're going to lose 7 to 10%. We have a stop of 7 to 10% of each of those positions. But two or three of them might double, and two might go up 1,000%. And those are the ones that will account for the majority of your gains. Basically, if position trading is your game and you don't want to be active on a daily basis, on a weekly basis, this is what you should be doing. Just look for huge volume range extensions.
And how are you scanning the market stocks to find these big volume breakouts? Are you using sort of a tool to do that, or some software?
Yeah, there's so many free. Well, not all of them are free. Screening softwares that offer you that. I mean, one that
like Finviz.
Yeah, Finviz is one of them. You don't even have to pay for it. And if I go right now to their website, and let's say I would choose average volume 50,000 for the day, and then under relative volume choose something super high like over 10. Price, you can choose anything over $1. Current volume, anything over 10 million shares, and then see how many stocks. Right now I see 6 names are coming up today, and 3 of them are biotech. And
really,
so that's basically what you do. You look at those, and so, for example, the first one they traded 200 million shares today is called Capricorn Therapeutics. It's up 250% today. So keep in mind that many of those, tiny biotechs, if they don't have a real news behind those moves, will get faded at some point. But this is why you use your stop. You have a stop in mind. But some of them will become, big long-term winners, especially if there is an earnings report behind that huge volume breakout.
Mm-hmm.
So yeah, that's it. Just find a screener, and there are quite a few free screeners, and just do that every day, and you'll probably find 20 or so decent candidates every single year, and you can just put 5 to 10% of your capital into each of them, and just manage your risk.
Awesome. Yeah, I just wanted to move on into a quick fire round just to finish off the podcast. It's just a few questions. Not going to take too long to answer them. It's just a little finishing thing we do at the end. What is it about trading that interests you?
Freedom and the opportunities that it offers. I mean, when you have the right skills and the right amount of capital, the amount of money that you can make trading, you cannot really make at most jobs. So this is why I'm in the business, because it's just the opportunities that it offers are just cannot really be matched by most jobs.
Yep, that's a good reason.
It still involves a lot of work. I mean, it's not easy by any means. It's not a 9-to-5 job. Sometimes you need to work 12 hours a day to hone your skills, but the opportunities it offers are just basically unmatched in most cases.
And favorite books? Have you got one that you would sort of say is your favorite for trading, and another that could be about anything?
Let's see. So there are quite a few good trading books. I wrote 6 of them. They're really good. But I think one that is a kind of good basis would be there's a small book written by Nicholas Darvas, How I Made $2 million in the stock market. Which is based on, so we don't even know if it actually happened historically. It might be just an imagination, but happened, I think, in the 50s or in the 60s when Darvas was he was a dancer who was just traveling around the world, and he was just trading based on quotes that were a week delayed. And his approach was basically buying breakouts to new 52-week highs within currently popular industries, and he would just use a super highly concentrated approach where he would just put all of his capital into 3 or 4 names and just make all of his money during a bull market and then just go to cash into a bear market. I mean, it's a very simple strategy that I think it continues to work today. So it's a kind of good basis to step on. Regarding a book in general, let's see, which one? I mean, I probably bought more books than I read lately, but let's see, the one that is really interesting to me, and obviously it's not just one, but let's see, what was something that really, I mean, and also if you want to just expand your investment knowledge, like all the Market Wizards books by Jack Schwager, good books that offers a historical perspective of what happened, and also talk a lot about psychology. That's also a good book. Good books. So more recently, one very practical book that I liked is called Atomic Habits by James Clear, where the whole premise of the book is that if we want to change our lives, we need to change our habits. So he breaks it down and explains how you can change your habits, how you can stop your bad habits, and how you can create new positive habits in a scientific way. So if you follow that, you can basically do anything you want. You can become anyone you want with enough persistence. So I think it's a very practical book. I do like practical books.
Brilliant. Yeah, that's good suggestions. And top 3 mistakes investors, or actually, well, probably more relevant is traders make?
I mean, most traders are very impatient at the beginning and undercapitalized. Like, everyone starts with a small amount of money and wants to get rich very quickly, and it takes considerable amount of time and effort to get to a point where first you break even and then you start making money all of a sudden. So just don't be so impatient. That's my suggestion. And then the second one would be, don't go over the place. Just choose one working setup. And there are many examples of working setups that you can get for free on the web, and specialize in that setup until you start consistently making money in it, instead of jumping all over the place. Just go deep and narrow instead of shallow and wide. Just specialize at the beginning. Just become profitable at one thing, and then gradually you can add some other setups to your arsenal. And what's another mistake? So impatience, undercapitalized. I guess just starting undercapitalized it's a big mistake.
Okay. And just finally, what's a top tip to keep calm in stressful situations? Is there anything you do to keep yourself calm?
Just take a deep breath. Just take a few deep breaths, just to calm you down. And I mean, if you're into meditation is basically taking deep breaths. And also try to think about all the things that you should be thankful for every day. That also calms you down, because most people have a much better life than they imagine. They're just remember that they're probably 90% out of the people out there in the world want to be you. right now and want to have your life. So sometimes you just need to look things from their perspective and just be thankful for what you have. Those are the things that I think are really important.
Amazing. Well, thank you so much for your time.
Thank you so much.
Ivo. Really appreciate you being on the podcast. It's really interesting to dive into your expertise. I'm sure people are going to really appreciate it. And if you're looking for more from Ivo, then you can join him at ivanhoff.com. There's 2 Fs, where you'll also find details on all his books that he's got available, which I highly recommend. He's also available on tweeting about the markets with the handle @ivanhoff2. Was there anything else you'd like to say before we wrap it up, Ivan?
No, that's all. If you want to learn more about my approach, just follow me on Twitter at, as you said, Ivanhoff2, or just I have a YouTube show called Momentum Monday with Howard Linson every Sunday. It's also free. You can watch that. It's 15 minutes review of what's going on currently in the market. And that's all. Thank you so much for
thanks a lot for that, Ivan. Thanks for your time. Thanks for listening, everyone. Just a quick note before we sign off. If you're looking for an easily digestible daily update on the markets, this might be of interest to you. Opto Updates is our short newsletter sent every day during a trading week, giving you a bulleted list of the top 7 stories from the global stock markets. We've done the hard work for you, highlighting relevant opportunities and trends, and in addition, we'll also keep you notified of any new podcasts, stock reports, or events from the Opto world. If you're interested, sign up using the link in the show notes. Until next time.